Today, we're covering fair lending training designed for the board of directors of banks. I'm Nate Price, president of Fair Community Credit Solutions, and I was with the FDIC for over 11 years, working my way up to senior compliance examiner and serving on fair lending knowledge management teams within the FDIC, plus another 5 years consulting on these topics after my time as a regulator. But this isn't about me, so let's jump into it. The basics of fair lending are the types of discrimination and the prohibited bases. The types of discrimination include overt discrimination, disparate treatment, and disparate impact. Now, let's stop briefly because I included disparate impact in that list, and the CFPB has proposed removing this as well as a similar executive order. Two things are important to understand here. Fair lending rules have a 5-year look-back period, so what you do now will be judged under the next administration. So the best way to approach your fair lending program is to build a program that will withstand multiple administrations. Additionally, the proposed rules are likely to be challenged in court for many reasons, so until all of that is sorted out and resolved, you are best to just treat it as it's still in place. The remainder of this video takes the same approach to fair lending programs as I just described. Back to the types of discrimination, and these definitions come directly from the FFIEC Interagency Fair Lending Exam procedures that guide the regulatory framework you operate under. First, overt disparate treatment, or overt discrimination for short. It's basically openly discriminating based on a prohibited basis. Next is comparative evidence of disparate treatment, or disparate treatment discrimination for short. This occurs when a lender treats an applicant differently based on a prohibited basis, even if it is unintentional. Where this typically occurs is in your pool of applicants that are not clearly well qualified nor clearly poorly qualified. Also, redlining, which we'll cover more later, falls under disparate treatment, and that is important to remember as your bank considers the proposals to relax fair lending laws and their implications. Lastly, disparate impact. This is when an otherwise neutral policy or practice disproportionately excludes or burdens certain persons on a prohibited basis. In the 21st century, most discrimination tends to appear to be unintentional. However, that does not matter, and it is your job as a board member to ensure that there are controls in place to ensure discrimination does not occur at your institution. The federal regulators are currently focusing on intentional or overt discrimination, but do not forget, there are state regulators and community action groups that can pursue both civil liability and try to ruin your bank's reputation. And the courts continue to uphold discrimination even if it is unintentional. So just continue ensuring that your program is strong enough to prevent and detect both intentional and unintentional discrimination. Let's briefly cover the prohibited bases. Fair lending is driven by the Equal Credit Opportunity Act, or ECOA for short, and the Fair Housing Act. ECOA covers all lending, while the Fair Housing Act covers all aspects of residential real estate related transactions. You'll notice a slight difference in the list between the two here. Primarily, that fair housing also covers familial status and handicap, which makes it easy to remember since they start with F and H, just like the Fair Housing Act. Most banks opt to simplify it and just not discriminate it in any transaction on any prohibited basis. But that's truly up to you on how you want to handle that. So now, what are you responsible for as the board as it relates to fair lending? You don't need to be involved in the nitty-gritty day-to-day analyses, but you are absolutely responsible for ensuring that appropriate controls are in place, which include policies and procedures, training, monitoring and audit, and your response to consumer complaints. All of these must be appropriate based on the size and complexity of your lending operations, so it's going to vary bank to bank. Before setting up any fair lending program, you must understand everything in fair lending is risk-based. Your goal isn't to prove that there's never been discrimination at your institution, because it would be next to impossible to do. But you do need to be aware of what the risks are at your institution and ensure you have appropriate controls in place. This means you need to have a strong fair lending specific risk assessment that shows your inherent risks, your mitigating controls, and your residual risk levels. One of the most important things the board can do is ensuring that you strongly promote a culture at your institution that discrimination is unequivocally unacceptable and has no place at your bank. Also, part of building that fairness culture is ensuring that appropriate time and resources are dedicated to the fair lending program. Let's walk through quickly each part of that program. First is policies and procedures. You set policies and provide the framework for procedures which need to be clear and detailed enough to avoid too much subjectivity or discretion, because discretion is exactly what increases your fair lending risk, particularly for underwriting and pricing. For example, your underwriting and pricing policies need to avoid vague criteria such as long-time customer. That could mean 6 months or 20 years. So each loan officer could treat that differently, which means your fair lending risk just increased. And then your controls would need to be that much stronger to control for that additional risk. Next is training. Your staff needs to be trained, especially those with lending responsibilities and oversight of the program. This includes the technical requirements, types of discrimination, and the timeline of fair lending risk, like you're receiving here. But it also includes meaningful and continuing training on your bank's own procedures to ensure consistency. Remember, discretion and lack of consistency is where fair lending programs fail. It doesn't help if you set up strong policies and procedures if nobody knows them or they just don't follow them. And this causes more problems than you would think when it comes to fair lending. For example, you might have a procedure to use a particular value in calculating loan to value for vehicles and on consumer loans. But oftentimes, loan officers just do whatever they were taught at their prior employer or just whatever seems reasonable to them in calculating that ratio, which can lead to customers being treated differently, which increases your fair lending risk and then requires more robust controls from management. Monitoring is the next program element, and it is that item that is going to identify that unintentional discrimination that continues to occur in banking. Your monitoring for fair lending should be tailored to the risks and tied directly to that risk assessment you started the program out with. This often includes a lot of data and statistical analyses where it takes a qualified person to do the work. So oftentimes that gets outsourced to a qualified consultant, or software programs are used for things like evaluating HMDA data. However, do not forget to monitor and analyze your consumer loans as well, as this is the product category that ends up in a lot of file reviews by the regulators, especially for underwriting risk. For example, I want you to ask yourself this question. Does our compliance staff know denial rates on auto loans for male versus female applicants? Or how about white applicants versus Hispanic applicants? And then ask yourself, do they have to, if that analysis finds disparities, do they have to report those to management, the board, or a committee of the board? If you are anything other than a small bank, and I'm talking 100 million to 250 million in assets or less, your answer to those questions should be yes. One other very important monitoring item that gets missed far too often is monitoring exceptions. Remember, discretion increases fair lending risk, so you need to monitor who is getting both underwriting and pricing exceptions and analyze them holistically over time in a manner that would actually detect discrimination if it were to be occurring. The regulators love to dig into this area because many banks just approve exceptions, include them in a board report, and then forget about them. But they fail to use this data in a manner capable of detecting discrimination on an ongoing and holistic base. As I mentioned, sometimes outside help is needed for monitoring, and external reviews or audits are necessary. This can be an annual comprehensive fair lending review of your program and your data for smaller institutions. Or if you're a little bit larger and you have your own robust internal monitoring already in place, which is great, it's still a good idea to have a qualified consultant perform a fair lending program review every 2 to 3 years to validate that your internal program is strong and there aren't any big gaps in controls that they've missed. This step is where you, the board, is ensured that you have implemented appropriate oversight, as well as the regulators love this. And they're far more likely to put reliance on your program rather than come in and look for discrimination themselves. Lastly, ensure that consumer complaints are investigated and handled appropriately. A complaint that alleges discrimination is taken very seriously by the regulators and often leads to file reviews and in-depth investigations. Often, management does more of a cursory review of these complaints and close the complaint because, well, they can't identify any overt statements from a loan officer, for example. However, you should require compliance staff to dig deeper, such as analyzing the loan officer's loans over the last couple years to see if there are any disparities in data that may indicate bias or treating applicants differently. Your role is to ask those questions when those complaints come through, such as what was involved in the investigation and specifically what data was analyzed to do a deeper dive and support our conclusions. I want you to also ask yourself as those come through and you see those explanations, would you be comfortable defending the bank based on the answers you receive if you had to answer to the regulator yourself? Now that we've covered all of the elements of the compliance management system for fair lending, let's talk about the fair lending risk timeline. One thing you must understand is fair lending involves all aspects of the credit cycle, starting before someone even applies all the way through payoff or collections. And you must have appropriate controls in place for all those stages based on the size and complexity of lending operations. Now, here is a visual of the timeline, which is very useful in also knowing what job functions are involved in each stage, which helps in assigning training for fair lending. While some job functions really only focus on one or a few stages of risk, at the board and senior management level, you are involved in ensuring controls for the entire credit cycle. The fair lending risk timeline starts with redlining risk. Redlining risk is a form of illegal disparate treatment in which a lender provides unequal access to credit or unequal terms of credit in an area because of a prohibited basis of the population. Redlining has been and continues to be one of the biggest fair lending focuses of the regulators. So you absolutely need to make sure you have strong controls in place for this risk, and we'll spend a little extra time on it. Remember, redlining is geography based, which some people forget and start thinking of application rates for minority applicants and such as redlining, but that's truly a marketing risk. We'll cover that next. So for redlining, the controls you should ensure are in place at your institution, which also does keep in mind, depend on the risk and kind of the market that you're in. But depending on that, for each assessment area that has higher minority geographies, these are the controls you should have in place. One, a branching location analysis that shows how your lending offices are located in relation to higher minority geographies compared to the demographic makeup of the assessment area. Two, you need to have lending penetration analyses that show how your lending penetration of HMDA and commercial loans in higher minority areas compares to peer or aggregate data. The third, now this is becoming more common, but it's not done all the time. The third one that you want to consider at least is marketing and outreach analyses that show where your marketing and outreach gets distributed as it relates to the area geographies, especially for geofenced ads and any zip code based advertising. And then fourth, and this one can be done more periodically depending on expansion or if your branches are changing or they're the same ones for the last 10 years. The fourth one that you want to consider is periodic reviews of your assessment areas themselves to ensure they don't arbitrarily exclude higher minority areas and that they appear reasonable. Also with redlining, do not forget your responsibilities for reviewing and approving policies here either. I have actually seen a loan policy that stated home loans would not be made in a specific county, and that county was the only county in the trade area that had a majority minority census tract. And sadly, the statement had been in that policy for over 20 years. Written statements and policies like that become very hard to defend, if not impossible. The next risk on the fair lending risk timeline is the marketing risk we've talked a little bit about. There is some overlap here with redlining, as you probably already guessed, because you need to know where your marketing and outreach penetrates by geography. However, this risk also covers who you market to. Now, over the last 5 years, regulators have started to expect more analysis in this area than in the past, such as monitoring market penetration to minority areas and persons, or the percent of ads with minorities pictured. These have become more of an expectation in recent years. Other traditional monitoring also comes into play, such as application rates based on ethnicity and race compared to peer lenders. And finally, this is also where hopefully your controls are strong enough to detect any loan officers that are discouraging applicants from particular groups. Steering is the next risk on the fair lending risk timeline. Now that you have an applicant and an application, we need to make sure that that applicant does not get steered into a particular product or service because of a prohibited basis. Make sure you have clear procedures on which products get offered and how they are presented, and then train your staff on those procedures. Then have your monitoring in place that analyzes if prohibited basis groups end up with one product over another more often at a disproportionate level compared to control groups. Typically, you're going to focus these analyses on higher cost and higher risk loans and products, such as penetration rates for Hispanic versus non-Hispanic borrowers for FHA loans, or sales rates for add-on products such as credit life, credit disability insurance based on gender. You should also make sure that your compensation packages do not encourage loan officers to steer customers, such as offering higher bonuses for secondary market channels versus in-house channels for loan officers that are able to originate both, which is actually illegal under truth in lending laws now. But it's a great example of what to look for. While steering risk remains a discrimination risk, admittedly, it does not currently receive the same level of scrutiny, typically, as some of the other risks we're talking about. The next risk on the timeline is underwriting risk. Just like we discussed before, the risk here lies in your borderline credit applications and with the discretion that you allow to your loan officers and management. Clear underwriting guidelines are key here to help promote consistency, but centralized and automated underwriting also greatly helps reduce risk in this area. Nonetheless, if overrides are allowed, that presents risks that you must continue to monitor and control. Monitoring typically includes denial rate analyses based on prohibited basis groups, and similarly, analyzing exception rates based on prohibited bases. Again, do not forget to analyze consumer loan denial rates, as consumer loan underwriting tends to result in a lot of investigation by the regulators looking for underwriting discrimination. Next up is pricing risk. Most of the time, when you think of pricing risk, you think of interest rates the borrower receives. But don't forget that this also covers fees and waiving those fees. A strong rate sheet and fee schedule with unambiguous criteria is key here. But just like underwriting, any discretion to deviate from the rate sheet or fee schedule means fair lending risk remains and requires adequate controls. Typically, that means exception procedures and analyses. Specific to pricing discretion and interest rates, if you find a significant disparity based on a prohibited basis, the next step typically should be a regression analysis that controls for all the variables in your pricing model. If you ever have been or ever are in that situation, you likely will need expert help, and maybe it comes from the outside. But the good news here is that doesn't actually happen all that often where it's actually necessary. Up to this point, all the risks on the timeline are pre-origination activities, which is traditionally what most people think of fair lending risks. However, remember that fair lending risks live all the way through the credit cycle, so servicing and collection risks still remain. These risks typically don't get scrutinized as closely, except during economic downturns, but be cognizant of these risks. The key to these risks during economically stable or good times, like it appears 2026 will be, is that your servicing and collection procedures are clear and that they are applied consistently. Now, 5 quick miscellaneous items, and then you'll know what you need to know for the year. Let's start with 1071, or commercial loan data that's similar to HMDA data. This has been dialed back a bit as far as the data fields that will be needed to be reported, but they are now set to start reporting in 2028 for everybody that must report. So this won't require developing new analyses in 2026 just yet, but it will mean the compliance team will need additional resources to gear up for that. And then once the data is available in 2028, that data should be monitored for fair lending risks, similar to how HMDA data is analyzed now. Next, regulators have flagged collecting of demographic information for HMDA as a focus of theirs because they've seen a lot of gaps in the data. You should have some sort of monitoring to ensure your loan officers are collecting required information when required on HMDA loans. Most banks are focusing this analysis on applications taken by phone, which actually makes a lot of sense because that's where the data collection gets skipped most often. If your loan officers skip this step of collecting the data, it creates data gaps that undermine your entire fair lending program. So this is a must. Similarly, you could probably tell by the fair lending risk timeline discussion that exceptions processes and monitoring are key to fair lending programs. However, most banks fail in ensuring that all their exceptions are documented and tracked. Again, this creates gaps in important data and undermines all of your exception monitoring if there are holes in the data. Next, remember, third-party involvement does not get you out of your fair lending responsibilities. So if you use third parties, you must have appropriate oversight of their activities regarding fair lending laws. In recent years, fintech partnerships have become more common, but fair lending problems with those partnerships have also been on the rise. Make sure your contracts call for fair lending controls and external reviews of their programs, especially if they don't allow you to access the information and do it yourself. Lastly, AI is all the rage in 2026, and I personally love it myself depending on the application and what it's being used for. However, be cautious with AI and lending, and if you use any AI tools in the lending process, know that that means you must have much more monitoring in place to ensure that AI doesn't unintentionally discriminate for you. As far as using AI to monitor and control for fair lending risks, this actually will open up risk to your bank because it will identify a lot of false flags that you then have to spend resources to explain and defend. Now, Fair Play AI, which I'm not affiliated with, they're doing some interesting things in this space. But beyond that company, I wouldn't touch AI for fair lending controls right now because anything that AI thinks it's found that is discriminatory has to be turned over to the regulators for review when they come in, unless that information is protected under ECOA, which it isn't protected as much as most banks think it is. And then you end up spending a lot of time and resources defending against false flags that never would have been needed to be addressed. Thank you so much for watching, and thank you for your commitment to ensuring equal opportunity for credit for all.